So in this two-part series, it will be a collaboration between me and Boon Tee, and we will essentially strip naked and present our vulnerable side to the internet. We will be showing our entire portfolio holdings out into the open. And we are essentially trying to roast each other and to really understand each other's thought process behind how we construct our portfolio to where it is today. So do feel free to roast us in the comment section down below as well. And of course, to help gently tap that cute little like button. And on a side note, me and Boon Tee recently just launched a separate podcast channel with Kelvin from Kelvin Learns Investing and also Eric. So do feel free to show your support, and if you can't get enough of us, subscribe to that channel as well. So with that, let's get right into the video. So for those of you who are unaware, there is a limited time bonus in lieu of celebrating Moomoo's 10th year anniversary. So if you open an account and deposit any amount on Moomoo today, you can get an extra $10 on top of the other welcome rewards, which will be worth up to 220 Singapore dollars if you deposit minimally 2,700. So Moomoo has always been a great platform for you to trade and invest in the stock market, and they've been a solid partner for my own investing journey thus far. So I personally am in love with Moomoo's new specific tab to keep us as veteran investors updated on real-time market developments around the company that you have a peculiar interest in. So on top of that, under the analysis category, they actually provide a snapshot of the daily short volume and even quick valuation metric just for your own references. So for those of you who wants to have a gauge of sentiments, there is also a built-in comments/discussion forum for different Moomoo users to express their different opinions. So for those of you who haven't signed up yet, don't let welcome rewards worth up to $220 go so easily. And don't forget, there is still an additional $10 during this period of celebrating Moomoo's 10th year anniversary. So I'll leave the link in the description down below. So for my US and Australian viewers, Moomoo is also running aggressive reward campaigns, giving out free stocks as well. Just make sure to click on the correct link below. Thank you, Moomoo, for sponsoring this video.
Okay, yeah, this is my portfolio at the moment. So I think this is really like strip naked. Everything you can see here, the numbers are here. I don't hide myself too much when it comes to portfolio, because the reason is that I think I can talk a lot on my channel and share a lot what I view in terms of like all this investment, right? But I think people are more interested to see that, okay, actually which are your biggest convictions, right? Because my portfolio, of course, the largest allocations one will be those that I have most conviction on. And then, of course, I also have some, small positions that I think I can call it experimental, just to try out, get some exposure, just to learn about the companies. But those are maybe not like the super high conviction one. So just a general view is that it's rather diversified, I would say. You see the largest allocations will be Apple at 12.3%, right? So this is the allocations. I would say almost like top 4 or 5 companies. These are the big tech companies like Apple, Microsoft, Amazon, TSMC, Nvidia, and Tesla. And then, of course, you can see here on the left-hand side, right? This shows my average cost as well. So as you can see, there are some in the red and some still in the green, and hopefully those green ones don't turn red. The top part here are mostly ETF. I would say most of them are those listed in UK exchange. These are the UCITS funds. So they are more kind of like tax advantage, and also the inheritance tax is lower than compared to, like, for example, the QQQ, right, which is listed on US exchange. Then the bottom part, these are individual stocks. And I would say my portfolio individual stocks still still dominantly in individual stocks. These are the companies that I have done my research on, and then I have conviction on them, even though some of them I bought it at a relatively much higher price. So, and in terms of the timeline, right, I actually started this portfolio since late 2017. So it has been 5 years now. Initially, I built it up with just ETF. As you can see here, these are mostly the blue color one. These are ETF. And then since COVID, which is early 2020, I really go heavy into tech stocks, because I think the COVID kind of environment is really favoring tech companies. And because of that, you can see that the red one just went up, right? And then, of course, market peaked at around end of last year. And for the past 1 year, the portfolio has been suffering quite a lot. I've been putting money in every month, but yet you see the portfolio still down, right? Just because there are quite a number of stocks that like corrected significantly, I would say, some even in a magnitude of 40, 50, 60, even 70%. There are some smaller positions that I have sold off, hence they don't appear here. I mean, that one you can of course ask question for those companies, but I think for today's view, I think Chicken may want to grill me on the portfolio that is shown here. So I stop here, see what kind of questions that Chicken have for me.
Sure, thanks for sharing actually. I think the first question is definitely, so if you scroll to the right, I think at its peak was at 400 plus 450,000, right? And then now it's back to 350,000. So that's
That's
a
right.
100,000 drawdown. Do you have any particular thoughts or any feelings that you're experiencing thus far
Actually,
over the
the
last 1 year?
100K down is just the portfolio value down because I still put money in, right? I haven't looked at the latest like the statements, but I mean, ballpark should be about close to 200K down.
Okay.
I mean, this entire 1 year. So if you ask me what's my feeling, right? I think I might want to refer you to my old video, the year-end video that I did 1 year ago, where, you know, when you do a snapshot at year-end, right, this is where we stand here. This is the peak, right? So I say that actually 2021 was a good year. My returns is great. But this kind of environment won't persist for very long one. For sure, we will have some sort of market corrections. 20-30% is normal. And I don't expect my portfolio to go up every year like that, right? And I say that as long as, let's say if the market down and I still put money in, I don't expect the portfolio value to crash by 100K. That's not what I expected. I think it should be, you know, like something like offset. Let's say if the market only dropped like 15%, right? So I think this is kind of like flat rather than go down. If you ask me, I will say not really sad. To me, this is something that, because I went through all this drawdown before, like I still remember clearly what happened in 2018 where my portfolio is still much lower. And then, of course, I went through the COVID crisis, and COVID crisis in terms of the steepness, right, is definitely more scary compared to the one that we are experiencing now. What is different now is that this drag has been quite long, like 1 year kind of drag. If you look at the S&P 500 index, right, it's going down like almost just down and down for 1 year. I think this kind of slow bleed is very painful for many people. To me, my feeling is more like, okay, the drawdown has been more than what I expected, but not towards like depression style, and I kind of like not looking at my portfolio level anymore. In fact, I'm actually getting more excited because of the valuation that we are seeing now. I think that now is the right time to actually accumulate stocks. But of course, many people always ask like that. They say, okay, is it time to buy now or not? My question is more like regardless of how low it is, right? Now S&P could be at, don't know, like let's say 4,000, right? It could be at 3,000. I won't call it bottom, you know, because there's always a possibility that it continue to go up or down, right? It's about probability. But one thing for sure is that the valuation has came down quite a lot. And this one, we can actually look at the statistics and look at the forward PE, Schiller PE, stock market cap versus GDP, like the Buffett indicator. We can look at all these and just get a sense of how expensive is the market. And right now it's not super cheap yet, but it has came down a lot. So at least that to me is a much safer level to enter and accumulate stuff.
So when you distribute them like this, right? Like you also say that it's pretty diversified. Why not just buy the S&P 500 or just buy the Nasdaq or because I'm quite sure quite a few of them they constitute a certain percentage as well, and it's quite favored to big tech as well. Why not just passively invest?
Yeah, I actually think that passive investment is a good idea. So in fact, when I started build my portfolio, I started out with ETF. Even during the COVID crisis, and I know that I need to pivot to tech, right? I didn't right away just buy individual stocks. In fact, during COVID, I still remember February and even March, right? I was buying QQQ, and that one is with a clear mindset of I want to pivot into tech. And QQQ is the easiest way for me to buy because when I look at their top holdings, right, those are exactly the kind of exposure that I like. But of course, you know, I'm very passionate about investing. I'm passionate about like looking into companies. Of course, when I look at companies, for example, like Apple, Microsoft, Amazon, I read their, their financial statements. I listening to what the management shared, right? And these are the companies that I understand their moat, and I want to invest in them. So I think the more direct way to get exposure is to just buy into the direct companies as well. So my approach, I'm not so, like very extreme to say that, okay, if you have 12% in Apple, that means actually you don't have convictions. This is just like, like no convictions kind of bet, right? To me, it's not the case. I do like kind of like not in extreme. I know some people extreme in ETF, 100% ETF. Some say, okay, I just do like 100% into single stocks, right? I'm somewhere in between. I'm kind of like, I look at Apple, I think that the allocations should be higher. So sometimes I just buy some and accumulate. Same for other companies as well. So what I want to do is that, over time, as long as I have money, then I will just buy companies that I like and just accumulate and accumulate. So even some of these companies, let's say if their fundamentals deteriorate in the futures, right? Then so be it. So I can lose money in any other any of these companies, right? But over the long term, what happened is that I would just accumulate the shares, and I'm quite sure that out of like say 10 or 15 companies on my portfolio, there will be some companies that will give me some multi-bagger kind of returns after years of investment. And these are the, this is how I built my portfolio. So, but I don't know which one. There could be companies that fail, right? I don't have that kind of like, insight to say that, for sure, all in single companies. So, and I do think that invest in single companies, it's just that it's too much stress, and then the volatility is just too much like higher, right? For me, going slow, going more diversified, and I can always rebalance whenever my view change. So I don't have to get married to a single companies, right? So that's why I think that our approach is quite different in this sense, lah. Yeah.
Okay, so like now, if I were to see in terms of like an absolute P&L level, right? Like
Yep.
the biggest bag that you're holding now is 0700, and for those of you who don't know, it's actually Tencent.
Yes.
So in this, from this perspective, can you like, what's your perspective now on Tencent? Are you intending to add? Are you going to cut? What are you doing with this Tencent position?
I actually made one video on Tencent, and I actually talked about that research. I think the main thesis from Tencent is quite simple. It's just talking about, okay, this is the company, the tech companies of China, but they have a strong armies of software engineers, right? I mean, in terms of business, there are, core business is in WeChat, basically the operating system of, all the peoples in China, right? And then also gaming, also their core business. So, and also cloud and others software related companies, they aren't so much into hardware, but more on the software side. And I do believe that when it comes to, ROIC, right? Like you want to get a return without having huge investment into hardware, right? Software business is always the one that gives us a much higher ROI. So that's what I believe in. And when I look at the capability of Chinese software engineers, right, I don't think they are behind US counterparts, right? They are also quite good in terms of designing their software. Hence, I myself are using WeChat. I do think that in terms of the UI, they are quite good. So my own investment into Tencent is like just to capitalize on this the capability of this army of software engineer, plus the dominant positions of Tencent as the gaming companies, and also their social network, and also basically WeChat, anything to do with WeChat, which is like much bigger than social network itself, right? So actually that's what I want to own, a piece of it. And I do think that the management, when it comes to managing their core business and also their investments, right, I also believe their insights when it comes to picking companies. So this is like combinations of a lot of things inside one things. And to me, it's just like just own it and just enjoy the ride. But it's just that when it comes to Tencent, my entry, right, it's kind of like unlucky, I would say, because I bought the one 700, which is listed on Hong Kong Exchange, and the lot size is kind of big. So after I bought it, right, so and share price tanked, and I do think that, okay, this is a company that I want to accumulate in, and I just buy, right. And because of the minimum lot size, the kind of tickets that I bought in is not like, 1,000 or 2,000 Sing dollar or US dollar, and I can accumulate over time. It's just that after one lot and two lot and three lot, now four lots that I have, right, it's already like kind of huge positions. And because of
Agree.
all these, concerns about like Chinese investment and so on, I kind of like toned down my expectation with regards to Chinese stocks, and hence I didn't add on for quite some time already. That's why the average price is kind of high, and I'm fine with that. For me, this is the allocation that I'm comfortable with, and I will just stay invested. Yeah.
Right. So if you talk about like concerns of Chinese investment, now if I look at it,
Mm.
you actually do have quite I wouldn't say substantial, but you do have quite a few tail end risks also, right? So other than 700, which is Tencent, you have 3690, I think is Meituan. Then TSMC is also in the middle of this whole geopolitical thing.
Yeah.
And you have a few companies that have direct access to the Chinese market, which is Apple as well. And I think some level of, let's say, ASML that is also concerned in that whole value chain thing, right? So how do you actually square away, or do you say that, okay, this is a China problem and I think that it only affects these companies, or do you take into account those valuations as well when you allocate your positions?
I would say when it comes to reallocations, right, I don't pay too much attention to the valuation. In fact, when I do on my investments, right, I would say that it's more towards quality investment rather than value investing. For example, I'm fine to buy ASML, even though if you just look at the PE and you just do a DCF on it, it's never a cheap company, It is a expensive company, and I'm okay to own it because like I say, let's say if I have 100,000 now and I started from scratch, right? If you ask me, like, I can only choose one company, I would say that SML would rank like kind of like I would definitely not buy this kind of companies because the valuation is so high, and then with a single entry 100K and I don't have fresh money, right? If I screw up in terms of the timing, then my entire investment screw up, right? So my approach is more like, okay, I have savings every month, I buy slow, and even if it's expensive, as long as I buy over time, I'm fine. Like these things, if I just invest for 10 years, right? The first entry, where is it? I don't think it's that important. So I'm fine to accumulate even though the valuation is high. So that's why ASML to me, of course, if it is high, I can buy in smaller magnitude and hope for price to come down, and then I will buy more, right? So that's my approach. So when it comes back to your questions with regards to like how do I like set the boundary, like which company will be affected by China or not, right? I do think that yes, China is a big topic. Say for example, China do some crazy things and not even like invasions, right? Just block Taiwan, right? It's not going to be just TSMC affected. I would say that Apple will be affected because they're cheap. They still get from TSMC, right? If you can't get TSMC cheap, the type of products that you can offer is just like not as good, and the quality, the pricing, everything just going to bad for Apple's, right? So same for other companies. I think most of the companies in my portfolio, including Tesla, Amazon, I think they all have some sort of business and get chips from TSMC, right? So that's how big TSMC is. So I would say that I'm concerned. Yes, I know that if these things happen, my entire portfolio will be gone. But I wouldn't say that like because all of them will be affected and hence I shouldn't care anymore, right? So it's more like see try to understand what's happening with the specific companies and try not to like paint a narrative and somehow like just guide myself with my own narrative. So come back to questions on Tencent again, right? Like how come Tencent I'm not buying, right? So I do think that actually this was asked by myself. I always use this question like all these investor, selling out of China and just exited, right? I do see this as a concern, at least for the short term, and hence I kind of like pace myself in terms of my investment into Chinese stocks. And the other one is that I actually like allocate too much into Tencent because of the lot size problem. Hence, it was over allocated at the first place. Hence, I didn't buy in the recent, let's say, 6 months. Yeah. So it's like a long story, but then actually try to guide my positions using this like a target allocations way. I can show you this. Actually, there's a hidden cell here. I don't know whether those who have a link to access this shared drive, they can actually open it or not. I'm not too sure actually. But if you open up, like what you see here is actually just a target allocations, right? It will sum up to 100% here. This is excluding the ETF part. So I actually want I want to target like this kind of allocations to different companies. And then whenever there's like under allocations, for example, now for Amazon and Tesla is kind of like under allocated because the prices came down, right? So I'll just try to buy more into those that is under allocated compared to my target. And But this is not like a sure thing one. It's not mechanically done, because sometimes when the price drop and there's some legit concern, sometimes I will just stop myself from buying also. So it's kind of like guide me in terms of like, okay, this is the allocation that I want. And secondly, it's just to pay attention to what are the catalysts. Catalysts could be positive and sometimes could be negative as well, right? So I kind of like use this as like something to guide my decisions when it comes to deploying fresh money. This is done quite frequently, like every month I'll buy, right? So this is done like quite frequently. But when it comes to sell, I would say that it's not so frequent. Like for example, I have for Meituan is like kind of like over allocated, right? But I usually don't like actively selling just because it is over allocated. So I'm kind of like just okay it is over allocated, because I anyway have money to deploy into those that is under allocated, right? So, I mean, that's my so-called the portfolio construction approach. I hope that answers your questions.
Right. So I wanted to take up on the topic on you talk about quality investing. So I will presume that, I think I also shared in the previous video that it's always a quality / valuation trade-off. So then in a booming market, at least for the last 2 years, when economy was good, everything was doing well, you can see that lousy companies, I don't know whether I will affect anyone, but if let's look at Intel, for example. We compare Intel because both of us own TSMC, right? So if we compare Intel and TSMC, we put them side by side, sure. A lot of quote unquote value investors like to go and catch Intel. They say, oh, it's a 5-6 PE, they give dividends, the company is a turnaround play. But then when you look at the numbers, it's like, oh, drop like 20% year on year or something. I've forgotten the numbers, but it's quite bad. And people are saying that, oh, it's short term because they are undergoing some restructuring. They're trying to resuscitate the business. While TSMC, on the other hand, crazy numbers, 40%, 50% year on year. But of course, we know that the supply glut is coming. So for next year, we are expecting a slowdown. So I'm not saying that the market is like dumb or like investors are irrational. So the sell down definitely got their own reasons. So I was thinking, if TSMC is going to be so bad, next year, like everybody's expecting so bad, then I really don't know what Intel numbers are going to be. So that's my perspective. So then comes the question, right? In a booming market, in a bull market, when everybody's spending, businesses are good, the quality is very easy to sieve out. So you see that, oh, this is a quality company because they're growing revenues. But then assuming that, let's touch wood, next year it's going to be bad, businesses are starting to slow down and everything is slowing down. How do you like look at the company and say that, okay, this is still good quality, or is it totally qualitative, or do you start taking into account the valuations and taking into account the numbers as well?
Yeah, I think that's a very good questions. I think for Intel, right? I should look into Intel quite in details, because I also want to understand what's happening with all these like competitions, right? When I study TSMC, I can't just look at TSMC. I need to understand what's going on with Intel. And in fact, like since I think more than 1 year ago, and I see that Intel is just not in a good shape. Like, just come back to your question on like qualities, right? Sometimes I do think that to differentiate, to tell whether a company is good quality or not, I think the most direct way to look at it is to look at their fundamentals numbers. For example, you can look at their growth. If there's no growth, right, how to justify, you see? Especially when the entire market is growing, your competitors are growing and you are not growing, there must be something wrong with either the product offerings, or whether it's the quality of the products, or something to do with the managements that cause this kind of deteriorations, right? So I think this is definitely one kind of like something to point us to look into more details, like why Intel, when it comes to, let's say, like server chips, why are they behind AMD? When it comes to, let's say, like retail products, why are they behind products or companies that use TSMC chips, right? And you do see that kind of problem that they are facing now is not like a short-term problem, for example, like the supply glut that you just mentioned. Because if it is supply, this is something like a macro. Of course, everyone's result will be bad, right? So that one, I do see that this kind of like cyclical slowdown is something that we are okay, because it will come back. Some market is just cyclical in nature. So I'm, as long as my investment horizon is longer than, let's say, 5 years or even 10 years, right? So all this short term is okay. But for Intel's case, I don't think this is like cyclical issues. I'm talking about like 1 year ago. The problem that they're facing now is that their product isn't as good. And it is not good because of their underinvestment in the past. So they've been doing a lot of things, because in the initial years, right, basically Intel are the one that they design their chip, they manufacture their chip. So they have a lot of power when it comes to shape the industry, and they are the dominant power. in fact, when TSMC just started, right, it's like a joke to Intel, you know, they are the small players. They will laugh at TSMC, like, okay, you only do one part, you only do the manufacturing, you can't even do the design yourself. What are you doing, right? So they have this kind of mindset because they actually control everything, including the driver, the software that used to control all this hardware. So, you know, software, hardware is not like just something that you can just chop, say this is the software, this is hardware. Usually when it comes to the detail and you want to really improve the things, you really need to control both the hardware and software part. That's how to make a products much better. For Intel, they really have an advantage on that. That's why when you compare, like in the initial years, right, you compare AMD versus Intel, Intel is always better because the drivers, everything is optimized for Intel chip rather than AMD chip. That's why AMD find it very difficult to compete with Intel for many, many years. But because of that dominant positions, they kind of like slack off and underinvest into their technology. And you can see that the kind of product or the process roadmap that they have, right, kind of like slow down. They just basically just milk their customer, you know, and they did it for many, many years until like TSMC come from behind and say, now because of all the monies that we earn, we just deploy back and we do R&D and we become much better and kind of like disrupt the entire landscape of the semiconductors. So after you try to understand all these details, right, you will see that, okay, this problem that Intel is facing, when they say they are like stopping, like they can't continue with the R&D to get into the advanced chip, like sub 5 nanometers, right? You know that they already screw up. They know that they can't compete with TSMC anymore. They say, okay, fine. For the less advanced manufacturing, the less advanced process, they would just do it themselves. But the really advanced one, they would just outsource to TSMC, right? So this is what happened during the previous CEO, Bob Swan. So he kind of already waved the white flag, said, okay, I just give up. After he announced it, the share price just tanked and he just do share buyback. So I think this is another one example to show that, you see, this is a leadership that we are looking at. He kind of like just, because he came from a CFO background, so he just gave up in terms of compete, in terms of technology, and just use financial engineering and do share buyback to help to cushion the share price drop, right? So when you see the management do this kind of things, it's like kind of like just gone case in my opinion, because they can't compete anymore. At most they can say, oh, we can continue to operate, and the price is so cheap anymore anyway. So even with a much smaller earnings, you can still get something like a decent dividend yield, right? So that's you will get if you invest in Intel, and that's true until Gelsinger came in, right? And Gelsinger came in, everything's shift. They say, okay, now chip is no longer just, you know, a retail things. This has become like a country security issue, and they try to get some support from the government to ask other fabs to build in US. So the entire landscape has become different, and they are now like want to compete in terms of advanced manufacturing. And the roadmap that they provided, right, is very, very aggressive. And I always share in the Telegram group, right, I said, this is the roadmap that they already communicated. If they really execute according to the roadmap, right, it's easily, I would say easily 5 to 10x kind of a result. But I was assigned like 5% chance for them to succeed according to that roadmap, you know. To me, for sure, there will be some delay. Just how many years of delay, right? True enough, after like 1 year, I can see that they already announced some delay, you know. And now recently they even announced layoff. So you can see that this is a company that's already like struggling, and I do see that they will continue to struggle in the future. That's why I do think that the quality is important. By quality, I don't mean just looking at their current financial numbers. To me, it's like just try to understand the company's inside out, try to understand their philosophy, try to understand their strategy, how they cope with the challenges that they're facing, and so on. So I'm a bit too much here. I think this has become a Intel bear story now.
Right.
Let me stop here.
No worries. I think it was a good kind of segue to really understand what you are thinking about when you're kind of trying to evaluate what's the quality of a company, right? But then here comes the question again. When I'm understanding you through that the whole quality process means that you have actually did your work and understand the competitors, right? Then we know that if we buy a particular stock or a partial ownership of a business, we cannot be saying that, okay, Apple today was 10 trillion. A bit don't make sense. That the net income, the numbers don't support that kind of valuation. So then will there be a cap in terms of like, or is quality your only focus and you don't care about like valuations, saying that if let's say Apple trades at like $300 today, even though we know that Apple is one of the highest quality companies in the world today, do you think you will still enter into a position? I know that your Apple position is you started quite long ago, so I think your average cost is like 100. So let's say Apple is like 300, 350, 400 today. At today's fundamentals means that they are printing today's cash flows, today's what? Assuming that everything is like ceteris paribus, everything the same. Will you still allocate even though it's one of the best quality in the world? But then here comes the valuation point, right? Where you identify that this is a good quality company, and I take ASML because it's a company that you wish to have a position in. So currently, if I look at ASML, the price is, your entry price is at around 576, right? Or no, 641, right?
Yep.
641. So even though it's a very high quality company, let's say ASML trades at like $1,000, for example. I don't know. I just anyhow throw out a number. Let's say ASML is at $1,000, but you determine that it's a high quality company. Would you still enter into ASML despite the high valuation?
Yeah, actually, the reason SML 641 I still buy is exactly for this kind of situation. To me, it's just like I do want to own this company. It's basically just a monopoly in their area, right? And I do see that this is the company I want to own, but it's too expensive. That's the reason why I own like a very small piece of it. And you see just 10 shares here, right? So to me, it's a small position. And in fact, if you just look at the pie chart, right, you can't really see it, right? It's so small here. But let's say if the price came down and then I want to increase my allocations, of course, I'll just buy more, right? So this is the kind of situation exactly like you just say. I buy a little bit, and then if I want to buy more, I buy more. So
you will really value the quality business, the quality part of the business a lot more than the valuations in this case.
Yeah. I would say this is how it works, right? So if the price is not right, but the company is right, I'll just buy very, very small one. But in order for me to increase it, let's say SML is 2%, in order for these numbers to become, let's say like 10%, few years later, right? There must be something, some threshold to pass in order for the allocation to increase. Because like I say here, I want to increase, right? I will ask myself like, that does it deserve higher allocations? Because if I increase more into SML, means that I will actually take this money that could be invested in, let's say, TSMC or NVIDIA or even Tencent, right? But what needs to be true in order to like deserve a higher allocations? I will keep on questioning myself. Like if the answer is after I questioning myself, yes, right, then I will just like increase my allocations. Then I will deploy the money into it, right? But this kind of questioning, I will do it quite frequently to keep on like, just monitoring the news, monitoring their quarterly result, and then just keep on asking myself like, do I want to increase allocations? So say for example, from 2%, every time it go up, right, I will just like, be conscious about their relative allocations. Like they have to be good enough to deserve a high allocations. By high, I mean something like, let's say you see like those TSMC above, let's say around 10% and higher. This I will be a lot more conscious and a lot more disciplined, including the valuation as well. So you won't see me like just because I like one company so much, even the allocation doesn't make sense, I kind of like just buy until like 10-ish%, right? So
and in this case, would there be a time where you like quote unquote take profit, even though the company is like executing? So whether Microsoft can continue executing, Apple continues executing, will you I don't know, will you sell to rebalance, or would you just let like your winners run, or however they like to put it?
in fact, I've never done that. Based on what I can recall, I've never done that. But I would say I cannot say never. Say for example, right? I don't know. Like I think one good example is companies like GameStop or AMC, right?
Okay.
But the companies that I own never experienced, at least in my view, never experienced this kind of movement. Let's say there's a movement that, just because I do think that it is hype, right? And it hype too much, right? I will rebalance. When this buy sell or to increase or lower the allocations, it's always looking at two things, right? One is the share price, right? And share price always fluctuate because of the hype, because of the fear, because of the news and so on. On the other hand is the expectation of the business itself, right? So if I compare these two and I feel that let's say the price is too much, some rebalancing I think is makes sense. If the other way around, I will buy more into like companies, especially they are under allocated in my portfolio, right? But I would say that the first case is much rare. Like for example, except for Tesla, I don't recall any companies that have this kind of situation. Say TSMC, for example, even at the high, right, 52-week high, I recall it's $140. I was still buying because number one, the growth rate at that point was still quite high. Number two, I do see that the quality that they have, right, and their philosophy and the valuation at that point, right, I don't think it's that crazy. I think it's fair. And I do want to allocate more. That's why I still buy when it was at 140. And of course, now the share price is like, I don't know, maybe $60 to $70, right? And we all know that the slowdown is coming. And I read the news, I know that it's coming. So it's kind of like, share price also come down, and then the price also come down. Then to me, if I do a weight of these two, I do see that there's more value out of it. But is it that much as like 50%? No, because the intrinsic value has came down a lot. If I do a DCF, I would put in a much lower growth rate, right? Because of the slowdown, the underutilizations of the 7nm and so on. So I think it's quite complex. There are a lot of moving parts. So just need to like steer it in a gradual way so that I don't make myself crazy. So I think it's good to do as little as possible, just let the things run, and as long as I have some money, I'll deploy it, like a small amount, so that it becomes like a gradual things instead of like, wow, I know this is true, let's whack, that's all in. That's not my style. Yeah.
Right. Actually, I also do agree. I think the investing itself is a very interesting topic. There is no correct way. I think at the end of the day, everybody just wants to like kind of earn money. So I don't really care whether like, is it diversified or sniper. If you have the magic to make money, earn more money, then kudos to all of you that I don't care whether you are trading or investing or doing whatever that is. I think last question to kind of end off this discussion, right? So I know you were an ex-Alibaba shareholder. I think for people that follow you, you invested and then you divested, but you still hold Meituan, you still hold Tencent. So I was just thinking, would there be a time, regardless whether is it the quality of the business or whether is it the valuation makes sense or what, that you will revisit, or maybe geopolitics cool down a bit again? Would there be a time where you revisit your Alibaba, your Tencent, or your Meituan conviction and add more exposure there?
Wow, this one's scary, these questions. I'm actually talking to all these hardcore Alibaba holders on why I'm not owning Alibaba. So is this a trick questions? Okay. I think for Alibaba, right? The reason I sold, right? I actually bought Alibaba just like I think I shared with you in the past, is really just want to participate in the Chinese economy. They're so big that you buy into Alibaba, you can almost like treat it like an ETF because of the e-commerce is big. As long as there's commerce, there's buy sell in the countries, right? These companies, they just take the take, and there should be profit come out of it, right? And we do see profits, right? So I think it's kind of like passive kind of way to look at the business, and that's why I wanted to own it in the first place. But like I mentioned, like in just like few minutes ago, right? I bought into the companies, I observe, I look at their results, and I did delve into their earnings call just to try to understand, like, okay, especially when they are facing headwinds, the result isn't that good, right? You want to like just try to understand because analysts will ask them questions, right? Like how you managing these kind of challenges, how will you strategize your business? So they will ask this kind of tough questions. Some are really like good questions and long-term questions. And I still remember I listened to Daniel try to understand, like give some explanation of what he tried to do, right? I just don't feel the kind of like, okay, I can see 100% what he's doing, and I do believe his way of managing the business. I don't feel the connection that, okay, this is the manager that I look for when it comes to how he's managing the business. That's the reason why after I sold out, right? Of course, when the result came out, I'm just like, just curious. I will still read into the business, read into the result, and try to see how are they performing. So I'm just curious. I'll just look into the headlines, and if there's any chat with regards to China, I'm happy to listen, right? But I don't think it's I'll be in a stage to say that, okay, I will change my mind, because somehow Daniel already give me an impression that, okay, this is not some like the way he managed the business don't give me the kind of conviction or confidence that he's the right person and he know what he's doing, because I myself also find it hard to understand what he's trying to do. You know, that's the challenge that I'm facing. Then the other one, which I think in terms of the fundamental result, is when they get into the grocery business, and I look at the profit margins, is like deteriorating every quarter, right? So to me, that one is also like, I don't understand, like is this the right way? I'm not saying that that's the wrong way. I'm just thinking that like they already moved from a high margin business to a lower margin business. Although they are able to grow, you look at the top line revenue grow, but actually the growth part is I would say the low margin one. And I don't know about the high margin part. Is it like zero growth, or is it like trending down? I have like no visibility. And to me, it's kind of like not so easy to look at the breakdown, because looking at their annual reports is also not kind of like very easy to understand kind of annual reports, right? So I kind of like already say, okay, I don't have to own every companies, and let's say if there's any things that convince me otherwise, of course can look into it. But I would say that I would first thing is to understand the leaders, and then to understand their core strategy. And if I really look at those core strategy and want to invest into it, then I will do. If that manager don't change over time, right? So that's why a bit hard to explain also. And I just want to say, this one is not just Alibaba, For example, like Meta, I read the entire earnings transcript. I would say that I don't understand what they are saying. Although this company is the company that I invested before. I would say that maybe when I invested, like let's say not a super big allocations, but when I invested, I won't say that I just buy blindly, right? Of course, I do understand something about the business. That's why I bought into it. But when I get into the details, listening to them, try to understand like how they are steering away from this entire iOS privacy problem, right? I don't really understand what they are doing. So it's a bit hard to continue to invest and say, okay, let's increase the allocations when you don't understand what the manager is trying to tell you, right? So that's the threshold that I set for myself. I hope that this able to answer your question and not like piss off too many people.
No worries. No, I don't think anybody will be. I believe it's at the end of the day, it's still an individual decision. Similarly, I think there are people that also might disagree with allocations of like myself or even you included.
Definitely.
So it's all fine. We are all here to just it's edutainment, education plus entertainment anyways.
Yep.
So I think with that, I wanted to thank Boon Tee again for this very insightful sharing in terms of his portfolio construction and his own investing philosophy as well. So you guys, please remember to help smash that like button as well. So with that, I'll see you in the next video. More importantly, I will see you on the moon. Goodbye.
Thank you. Bye-bye.